In this lesson, we're going to go over another concept related to dilutive securities and figuring out what a company's true worth is by looking at both its basic equity value and then its diluted equity value. Diluted equity value referring to its market cap when you take into account the potential for new shares being created from securities like options and convertibles. Now, in the previous video, we took a look at options and we saw how we use the treasury stock method here to look at Apple's current share price, the exercise price of their options, and use that to figure out what their diluted share count was. In this video, we're going to look at a related topic, and this one is going to be about convertible bonds. Unfortunately, Apple as a company did not actually have any convertible bonds on its balance sheet, so I can't use real numbers from their filings to go through this example with you, but what I want to show you here are some of the key metrics with convertible bonds, some of the vocabulary and lingo you need to know, and then how to make the appropriate calculations to answer these questions in the context of interviews. Now, with options, we saw that what happened is basically you have an exercise price, and essentially you pay a company money to acquire shares at less than market price. So if the exercise price of options is $20 and the company's stock price is $100, then obviously you would cash in your options and get shares for only $20 rather than $100. Convertibles, by contrast, are a little different. With convertibles, we have a security that is debt, but which can turn into options. So normally it's debt and there's an interest rate, which could be zero, but there's always some kind of interest rate associated with it. And then at a certain share price, it turns into shares. So similar to options, there's also an exercise price or strike price for convertibles. And going back to the example from before, if that price is $20, let's say, and the current share price of the company is $100, then we'd assume that the convertible investors would turn their convertible bonds into shares of the company. And so that's how it would work. Now, I mentioned just now that convertibles are normally debt with an interest rate associated with them. For our purposes, for calculating the equity value and enterprise value in this course, we're not going to worry about this too much. We're going to be more focused on the second scenario here, where the convertible bonds actually turn into shares at a certain share price. And in some ways, this is actually easier to think about than options, because unlike options, the company does not receive cash when you have convertibles. So when you have options, as we saw in our example over here with the treasury stock method, you're paying the company $81.17 per option to get a share. With convertibles, by contrast, the scenario is actually very simple. What would happen here, for example, is instead of having to deal with this complex formula over here for taking into account how many shares the company repurchases, all that would happen with convertibles is that this full number, the 34 million, that would be counted as dilution, and for every single unit of convertibles, you would get a new share being created there. So conceptually and in terms of the math, convertibles are actually easier. The difficult part with convertibles is that you may not be familiar with some of the lingo, and that some of the equations and how different variables here are linked together can get a little confusing. So I'm going to go through an example right now of how to make this type of calculation and how to go through these calculations in the context of an interview and how to answer questions on this topic. So the first piece of information you're usually given about convertibles is the dollar amount that's outstanding. Here, I'm just going to keep it at 10,000. So in the context of an interview, they might say that you have $10,000 worth of convertible bonds, or $1,000 worth, or $100 worth. Once you have that, the next question you need to figure out is that's the dollar amount, but you need to figure out how many physical bonds there are. And really with convertibles, there are three things you have to think about. One is the dollar amount, one is the number of bonds, and then the last one is the number of potential shares. And these are all related because the dollar amount determines the number of bonds, and the number of bonds determines the number of potential shares. But you have to go through a multi-step process like that when you're dealing with convertible bonds. Now, the way you get to the number of convertible bonds is from something called the par value. The par value is similar to what we saw with the par value of common stock in some of the accounting tutorials. The difference here is that for convertible bonds, you usually assume the par value is 1,000. So basically you're assuming that the value of each bond issued is $1,000. And you use that to calculate how many bonds outstanding there are and ultimately how many shares could potentially be created from this. So to calculate the number of convertible bonds now, we take the dollar amount and divide it by the par value right here. So we know that we have 10 convertible bonds outstanding. So that takes us to the second piece of information we need, which is the number of bonds. Now, to get to the number of potential shares, we need one of two pieces of information. We either need the conversion price of the convertibles or we need the conversion ratio. In other words, with these bonds, one bond corresponds to how many shares. And you can probably tell already, but we can take either the conversion price and use that to get to the conversion ratio, or we can take the conversion ratio and use that to get to the conversion price. In this example, I'm going to start with the conversion price and say $20 here. And then for the conversion ratio, we are going to take the par value and then divide it by the conversion price. So we have 50 right here. Now the reason we do this is because the bond as a whole is worth $1,000. And so if you can convert it at the $20 level, then that means that each bond will correspond to 50 new shares outstanding. So the conversion ratio could also be called the number of new shares per bond or something like that, if you want to think about it like that instead. So for the potential dilution here, it's just going to be the conversion ratio times the number of bonds. So in other words, we're taking the number of new potential shares per bond and then multiplying it by the number of bonds. One thing we should actually add to this formula is an if statement. We should say if the conversion price exceeds our share price, then it's 0. Otherwise, then we have this scenario happening. The reason why we have to add that in is because similar to options, if the conversion price is above our share price, then we cannot convert these and these are going to remain as debt, and so they should not be counted toward our diluted equity value in this example. So in this case, since our conversion price is $20, well below the share price of $100, we have $500 worth of dilution here. Note that I'm not worrying about how much cash the company gets or buying back shares or anything like that, because with convertible bonds, you don't worry about that. You just worry about straight up how many new shares could potentially be created from these convertibles. So to complete this example now, for the diluted shares outstanding, we're going to take the dilution from the convertible, we'll add the shares outstanding, and then for the diluted market cap, we'll take diluted shares outstanding and multiply it by the share price. So we see that in this case, the convertibles are responsible for around a 50% dilution, which is huge. In a real scenario with a real company, that would never happen. That is simply way too high and it's out of line for what you normally expect. Again, I would say 10%, maybe 20% max would be normal for this type of dilution from convertibles and from options. Anything above that is cause for concern. So this example is more theoretical for your own purposes and for interviews to give you round numbers rather than actual, because a company would very rarely get this much dilution from one issuance of convertible bonds. Now to go through a slightly different scenario here, so another common thing that can happen when they give you this type of question is instead of giving you the conversion price, they may give you the conversion ratio instead. So let me show you what to do in that case. So if we have $10,000 worth of convertible bonds, we're going to stick with our assumption of 1,000 for the par value. That tells us that we have 10 convertible bonds. Sometimes in interviews, they may just give you the 10 of convertible bonds. So you have to do a little bit of detective work and figure out the missing pieces of information. But this is what we always start with, the number of convertible bonds and how much in dollar terms it actually corresponds to. So if they give you a conversion ratio instead, so let's say that they give you a conversion ratio of 20 here. So you can see already that the dilution formula here is calculating this. We're taking the conversion ratio times the number of convertible bonds. But we have a big problem here because what we need to do now is figure out what the conversion price is. The way we do this is we take our par value and we divide it by the conversion ratio. So our conversion price in this case is $50. So remember that relationship between conversion price, the conversion ratio, and the par value? Par value divided by conversion price gives you the conversion ratio. So you can always use simple algebra to change around that formula and figure out either the conversion price or the conversion ratio. You're going to need both of them to answer interview questions on this topic, because to figure out whether or not you have any dilution, you need the conversion price. And then to figure out how many new shares actually get created, you're going to need the conversion ratio. So you really need both in this scenario. Just going to undo this and go back to our original scenario here. So that's an overview of how you go through and calculate dilution from convertible bonds. Again, I know some of the terminology and lingo may be unfamiliar to you, so if you look in the handout going along with this course, it gives you some of the terms, defines them, and gives you the formulas, and gives you a couple examples of how to use them. So you should go over that and review this. I would say in general, convertibles are not one of the most frequently asked about topics in interviews. You could get questions on them, but to be honest, they come up much less frequently than other topics like the three statements, valuation, DCF, things like that. So it's good to know this and to be familiar with it, but I would not focus on this because it's certainly one of the less frequently asked about topics in the context of interviews. But hopefully now you should know enough to be able to answer these questions in interviews. And if anything is still unclear, again, I would recommend looking at the handout to read a summary of the formulas and how convertible bonds actually work. Coming up next, we're going to be going into our next topic here, which is to look at a company's enterprise value. And we're going to be going over an analogy that explains the difference between enterprise value and equity value, and then going into our calculation here that shows us how we actually arrive at the enterprise value number for a company like Apple.